In this audio recording, I'm going to be talking about the FATF 40 revision. The FATF had 40 principles on anti-money laundering and another 9 principles on combating the financing of terrorism. In February 2012, these principles were essentially merged into one set, which is now the FATF 40 principles for AML and CFT. This audio recording is essentially an overview of the topic, and it's an extract from my speech at a public conference in Taipei, Taiwan in February 2013. So preparing for the program impact. It impacts your business model. So those banks that have used tax evasion money to build up their balance sheet, they need to take a relook at their basic business model because it's now a predicate offense for money laundering. If you have operations in countries with countermeasures, then it's going to increase your cost of doing business because your supervisors are going to look into your operations in these countries. And of course, countermeasures are not just by the FATF, but any country can come out with countermeasures. It impacts your policies and procedures, your systems and resourcing. For example, the FATF 40 now needs global programs. It has a lot of emphasis on the risk-based approach. It always had emphasis on the risk-based approach, but however now it explicitly talks about risk assessments. And the risk assessment piece, as we all know, is becoming an incredibly important part of your AML program. Regulatory actions in the US have highlighted that the risk assessment expected can be onerous. It's not just a risk assessment of a line of business, but it's an enterprise-wide risk assessment which looks at things like your products and services, which looks at things like your specific groups of customers and also specific customers. Then it also impacts your policies and procedures because the FATF 40 now has greater detail on beneficial ownership, identification and verification processes, and we'll talk about that a little bit ahead. And then information sharing is required intra-group between a large banking group. The FATF 40 expands international cooperations and the financial intelligence unit's powers to ask for information from financial institutions. It also increases regulatory risk, and this is specifically with reference to tax evasion. So, tax evasion monies which you've booked for another country, in the past they would not come under scrutiny, but now the money laundering channels will be used to exchange information on tax evasion. Tick box compliance is not acceptable. The risk-based approach needs focus, and accordingly training will be a key focus area. And building an effective risk-based approach, building an effective risk-based compliance, and risk-based culture is certainly not an easy task, and there needs a huge amount of investment in training. Expect supervisory focus on risk-based approach validation during inspections, in particular on the risk assessments that you would come out with. Ongoing quality assurance will become key to ensuring group-wide consistency. Dealing with privacy concerns is key to sharing of information for risk management purposes, and you have to come out with cross-border policies, and you have to work with your legal departments for that. Reviews of clients are needed to identify clients' tax risk profile and the legitimacy of assets booked. And in countries like Singapore and Hong Kong, there are extensive exercises which are happening currently on existing clients and also on new clients. Effective governance structures are key to ensuring an effective risk-based approach. Involvement of general compliance, legal, risk, and business in anti-money laundering is absolutely essential. So continuing with customer due diligence, it gives flexibility and clarity on scope of reliance on customer due diligence by third parties. It brings in an element of country risk into the evaluation of third parties, and it talks of intra-group reliance if the risks are actually mitigated by your policies and procedures, etc. Financial institutions now apply enhanced due diligence based on overall risk posed by a country. In the past, there was a focus on whether you're a FATF member or not a FATF member. Now the focus has moved to the actual risk of the country, irrespective of membership. It's very clear that domestic PEPs now need full identification, and it also talks of international PEPs in the same vein. So, international PEPs meaning, international PEPs of international organizations in the same vein as domestic PEPs. It makes it clear that you cannot use the risk-based approach for foreign PEPs. And there are various other details which you should look at for PEPs within the FATF 40. For bearer shares and warrants, there is now explicit language and emphasis. It prohibits them. You can convert them, for example, demat, you can immobilize them, or you could require notification. It requires enhanced transparency and control around nominee shares and nominee directors. The names of the nominator need to be disclosed, and the parties providing nominee shares and nominee director facilities need to be licensed. For wire transfers, it now requires beneficiary information to be included. So the required beneficiary information now must be included with the wire transfer. There are also some technical enhancements. Sanctions now covers the UN financial sanctions on proliferation of weapons of mass destruction. For money value transfer systems, there is an increased emphasis on registration and enforcement around this, which means that banks need to have greater emphasis on suspicious transaction report filing processes around MBTS and unregistered MBTS. Countermeasures can now be based not just on a FATF call, but also by themselves. So countries can come out with their own countermeasures. The financial intelligence units and legal enforcement units have been given better operational tools. Legal enforcement agencies, my apologies, have been given better operational tools and a wider range of techniques and powers to both investigate. So they're allowed to ask for additional information from those filing STRs. And not just from those filing STRs, but if Bank A files an STR which is linked up with Bank B, then the FIU can go to Bank B and ask for information also. And of course, in many countries, this may always be the case, but I'm talking about the FATF standard here. So new powers to prosecute as well. There's greater focus also on cross-border information sharing using the Egmont Group principles for information exchange. So what are the enhancements to laws and regulations that you can expect? And this impact will obviously vary according to the standard in country that, the country that you're operating in. So the impact in the UK will not be the same as the impact in Singapore or Hong Kong. Expect greater focus on tax evasion, that's for sure. Greater focus on risk assessments. So invest greater time and effort, build teams to make sure that you get your risk assessments right, and your entire AML program must be based off your risk assessment. Expect greater focus on information available for customer due diligence for both companies and trusts. There's going to be greater focus on global programs with a local reference. So yes, you have to have a global program, but in countries like Singapore or Hong Kong, you need to also refer to the local regulations. Expect greater focus on cross-border information sharing, both within financial institutions, intra-group, and within financial intelligence units and legal enforcement agencies. Greater emphasis on cross-border business policies. So work with your legal teams to figure out if you have customers from India opening accounts in Singapore, what is it that you will expect and accept. So if there are foreign exchange limits that are imposed on people taking money, keeping money abroad, then what are those limits and how much of money should you realistically expect? Expect greater emphasis on training, especially for the risk-based approach. Invest in e-learning. E-learning will help you get there, including on, for your regulatory requirements. In one of the old firms that I used to work with, we used to have regular training once a year, which covered not just the global policies and procedures, but also specific regulatory requirements in local regulations, local country regulations. And that was all through e-learning. Expect greater focus on quality assurance. If you want to understand this standard, look at ISO 9000 2008. Large banks have started setting up quality assurance units, not just, it's also now on the business side, within operations. So QA is not just something which the compliance testing team does, it's more wider. And of course, quality assurance is also an integral part of any internal auditor's job scope. So an effective QA process will not just check the existing procedures for adherence, but will also question whether the existing procedures are adequate in the first place. Expect greater personal accountability, not just of MLROs, but also of senior management. Expect greater focus on governance, and governance needs to work. So it's not just creating the structure, asking questions like, are people attending? Is the right information being shared with the governance structure, with the governance committees? Is action being taken on pending items? Is there follow through? Is governance supporting the AML function? So are you getting financing, for example? Things like that. Expect supervisory focus on the risk-based approach validation. So in inspections, the supervisors will look at what decisions you've made and how you've made them and what's the documentation around those decisions. Expect that both information expected and shared from and to financial institutions will increase. And there may also be country countermeasures, so individual countries may come up with their own countermeasures, although I personally would very much doubt whether that would actually happen.